Welcome back to the Commercial Property Podcast. And I'm going to be talking on today's episode all about investing overseas. So everything I talk about on this podcast is about investing in UK real estate, UK commercial property. And there's a reason why I don't venture into talking about US real estate or Germany or Portugal or whatever. Because every market works differently. And so I'm a specialist in UK real estate, UK commercial real estate, but I never profess to be an expert into other markets. However, at this time of year when we're all going on holiday, it's really interesting. I've just come back from a holiday and I was really noticing, and the trouble is when you start getting your eye into commercial property, you can't unsee a lot of stuff. So you can't help yourself kind of noticing what's happening on high streets, industrial estates, and the dynamics of, I was in France, and the dynamics of what was happening in the particular area that I was visiting was really interesting. You know, a lot less brands on the high street, much more kind of individual boulangeries and patisseries and boucheries, like butchers, in individual little shops, very, very few brands actually, on the high streets, and, much more soul on the high streets. And then if you go out of town, yes, you've got your big Darties or your Auchan's or your, big Carrefours or whatever. Yes, you've got those. Although I have to say, I definitely prefer a French supermarket than a British supermarket, but that's a topic for a different day. But then you've got like little industrial estates, which are working a bit differently. They will do over here. So the point is that the real estate, some of the real estate over there looked very, very similar to in the UK, but it operates very, very differently. And so kind of at this time of year when we're all kind of thinking, oh, it would be lovely to live in Portugal or Germany or France or whatever, and, I can invest there. I think there's just some things that you need to know about before you start making those kinds of decisions, because the principles are often similar, but the legislation, the culture, the financing, the lease structures, the tax rules, and the kind of supply and demand, the tenant expectations, they can be completely different. And it's very easy to be attracted by lower prices, higher yields, and definitely the appeal of kind of owning properties in the sun. But you definitely need to understand the legal systems. Commercial property is so much about law; it's about leases, because that's how you value it. And the businesses occupying the buildings, you really do need to get under the skin a bit. And so any investment, whether it's in the UK or overseas, that looks fantastic on paper can very quickly become a headache if you don't understand how that market operates. And, us people that bought properties in Romania and Bulgaria, and are trying to unravel those still, kind of definitely a lot of lessons to be learned. So I just wanted to focus today on the difference between UK and overseas property. I have to generalize because every jurisdiction, every country is different in the way the market operates. But I'm going to give you some generalized views on how I think that they differ, and some advice for you if this is what you are determined to do in terms of investing overseas. So there's plenty of reasons to invest outside the UK. I'm the number one in line for a diversified portfolio. And I guess diversifying by country is the ultimate diversified portfolio. And, whether you're relocating or buying a holiday home or just spending more time overseas, there can be excellent opportunities. Genuinely, there can be some fantastic opportunities, but only if you understand the markets that you're entering. So I think the first rule is don't assume the UK model applies, because it rarely does, actually. And, this can be partly to do with lease structures, repairing obligations, rent reviews, landlord and tenant legislation, financing, taxation. They all vary enormously by country. And so before you even look at property, you need to kind of spend some time understanding how this operates. So for example, we have a very clear legislative system in the UK, but and you know, we can get longer leases, but very short leases, rolling breaks, you know, few inflationary linked reviews, different ways of buying and selling. They're very common in Europe, for example. And so, you know, in the UK, we're very fortunate to have very well established lease structures. And a lot of commercial properties are on full repairing and insuring leases, giving landlords predictable income and hands-off income, you know, not passive, but hands-off, and limited repairing obligations. In lots of other countries, you may find, like I said, much shorter leases, easier ways for the tenant to end leases. You know, in the UK, it's actually, if you're tied into a lease, unless you've got a break clause, you have to stick to that lease. You know, that's the legislation. It can be different in other countries. The law can be a lot more in the favor of the tenant. Different repairing obligations, government controlled rents in some countries, inflation linked rents, no rent reviews at all, and a very different security of tenure legislation. So understanding leases and lease structures is every bit as important as understanding the property itself. And of course, valuation methodology can also change from country to country. You know, the RICS governs valuation in the UK. There's also kind of lots of branches of the RICS overseas, but in some countries that just doesn't apply. And so RICS tend to be a bit more in English-speaking countries, but you know, they control valuation methodology. And also the other people that control valuation methodology is lenders. You know, if lenders have different criteria in different countries, then you need to really understand what that is, because that will affect the instructions they give to their valuers and therefore the valuation methodology as well. Every country has also got its own legal framework. So, you know, you need to kind of find out how straightforward it is to buy properties, and also how safe is it to buy properties. You know, there's reasons why a lot of overseas investors from the Middle East, you know, formerly Russia, obviously that's not permitted anymore, but the Far East, from China, from, you know, different legislative areas. There's reasons why they invest in the UK, and that's because, you know, it's very unlikely that the government's going to take the property away from you, or you're going to find that actually the person who sold you the land didn't actually own it in the first place anyway. You know, the legislative structures in the UK are a lot better, they're a lot more advanced than a lot of countries. So that's just something to think about. You know, also think about, can overseas investors own property directly? Because in some countries that's just not allowed. Whether there's ownership restrictions, whether you have to be living there for a certain amount of the year or whatever, how contracts are enforced, how long transactions take, how you can do these checks and balances on ownership as well. And also things like what happens if the tenant defaults. You know, what's the law around that? What happens if the tenant doesn't pay their rent? Kind of what can you do? In the UK, you can send bailiffs in, you can serve statutory demands, and you know, it's a relative, as long as your lease allows it, which most leases do if they're drafted properly, it allows you to resolve that particular issue very quickly. It may not be the same. And so my strongest recommendation is to appoint a commercial property solicitor who specializes in commercial property, not just a generalist, but only within that jurisdiction, only within that country, because they will understand the way everything works. And then obviously the same applies for finance. You know, don't assume you can obtain finance in the same way that you can in the UK. So for example, will banks lend to overseas investors? What kind of deposit, you know, do you need? What kind of loan to value can you get? Where are the interest rates? Will they lend against the property, or will you need to provide personal guarantees, other security as well as the property? And actually, would you be better off borrowing in the UK? Because finance can, you know, commercial property is a finance game basically, and it can completely change the viability of a deal. And obviously tax is kind of an add-on to this, because tax is where a lot of investors become unstuck. And again, my strongest advice would be to get specialist tax advice within the country and jurisdiction that you're looking to invest in. But things to consider are, what's the level of purchase taxes? Is there a premium if you're an overseas investor? What are annual property taxes? Some countries have those. What's capital gains tax? What happens? Yeah, what happens if you sell? What kind of tax? Can you get the money out of the country? Corporation tax. What happens if you don't pay the tax? What are the kind of implications for that? VAT or local sales taxes, do they apply to property? What are the inheritance rules? Which, does the country that you're looking to invest in have double taxation agreements with the UK? Really important to get specialist tax advice there. And then added onto that is currency risk. One factor that a lot of investors don't factor in is currency. And your investment may increase in value while the exchange rate moves against you, and it can offset some of that value increase. So, and the rental income could also fluctuate if you want to take it and you're still living in the UK. So if your mortgage is in one currency and your rent's received in another, you introduce additional risk. So it's just worth understanding how you can hedge some of that currency risk, and whether that's a risk actually that you want to take. But commercial property is very much about businesses as well as buildings, because the businesses are going to be the tenants, they're going to be the people taking the leases, they're going to be the people ultimately that are paying your mortgage for you, or paying, because they're paying the rent. So the same research that you would do if you're choosing a niche in the UK is relevant kind of if you're helicoptering up at a country level, kind of all this due diligence I've just talked about, but also the supply and demand is so important, and if you've chosen a country to invest in, then again, just like in the UK, there's winners and losers in the sectors, in locations, in tenant types. So it's really important to be ahead of the curve with that. And it's not necessarily the same as in the UK, because culture's different. And there's different norms that will promote different types of businesses than we may get in the UK. There may be some similarities, but obviously that's down to your research. So it's about what businesses are growing, which sectors are declining, what are the kind of trends that are happening in that particular market? Is the local economy expanding? What locations are winning, and why are they winning? Is everything future-proof for the future? Obviously with AI, we need to look at that in wherever we're investing. Who are the major employers? But like I said earlier, if you're investing in the high street, for example, are you going to get a local butcher or patisserie, or are you going to get, a national brand? And which one do you actually want? Again, what infrastructure projects are planned? Is the population growing? What does the future look like? Because the same principles apply. If it's a beautiful building in the wrong location with weak occupier demand, it's still a poor investment. And then obviously once you've bought, then, and like I said, the finance is very different. So you need to speak to a country-based finance broker, so somebody based in that country who can advise you on the finance. That's obviously really, really important, because that will affect your lending criteria, your valuations, the amount you can borrow, your interest rate, your loan to value, and all that kind of stuff. And then property management. So once you've bought, managing something 200 miles away is one thing, but 2,000 miles away is something completely different. So, have you found some good local managing agents? Maintenance contractors, legal support, insurance, rent collection, who's going to collect your rent for you, dealing with vacant units, language barriers, time differences can be a big barrier. So having the right team on the ground is essential. And I would go as far to suggest that you wouldn't want to buy anything in a country, no matter how profitable, if you haven't got the right local team to manage it for you. So that's just really, really important. And then, so your due diligence is going to be a lot more important. Due diligence is always super important. But, it should be even more thorough. than it is in the UK. So, you don't want to be relying on the selling agent. You never do, whether that's in the UK or overseas. You need to verify everything independently, and building a great local team of agents, solicitors, surveyors, accountants, tax advisors, et cetera, property managers, because local knowledge is invaluable. And just like in the UK, the knowledge that's applied in one city that might be 100 miles away may be completely different than the advice you might get for another. So, that's why it's so important. So it's really important when you're looking at overseas investing to think beyond the headline yield. Things might look a bargain, things might look, cheap, the returns might look amazing, but a property producing a 10% yield overseas isn't necessarily a better investment than something generating 8% in the UK. There might be a reason why the yield is higher. The yield reflects the risk. And if there's a high yield because it's more risky, because there's a less landlord favorable lease structure, because the tenant you're getting isn't as good, then you need to understand exactly what you're paying for. So don't be lured by cheap prices. You need to do all your checks and balances, just like you would do in the UK. For some investors, overseas investing can be a fantastic diversification play. It can be absolutely right for them, especially if they're looking to go and live in that particular jurisdiction. If you understand the market, if you've got the right advisors, and you take the time to carry out your due diligence, commercial property can be overseas can be an excellent addition to your portfolio. But if you're buying simply because the property looks cheap or the weather's better, you could actually be making a really, really expensive mistake. So, just a little bit of a checklist before we finish. Before investing overseas, number one, do you understand the local commercial market? Really important. And if you don't, how can you find out that knowledge? And I've gone through that earlier. Do you understand the lease structures? Is that going to affect your ability to get lending? Who can you get lending from? Do you understand the finance options? Have you spoken to a great broker? Have you spoken to various brokers? Have you done your due diligence on that? Have you taken specialist legal and tax advice on your personal situation? Because everybody's different in terms of how well set up they are to invest overseas. Have you researched tenant demand? Do you understand the market? Do you understand a niche that would work? Have you understood currency risk and ways to potentially mitigate that? Do you have trusted professionals on the ground and a team that you absolutely trust to be able to manage the property for you? And are you buying because it's genuinely a good investment, or is it kind of a spur of the moment thing? Because I would suggest if it was spur of the moment, if it's on a whim, you absolutely want to be getting the fundamentals right. And, the period between kind of thinking about doing your due diligence, then purchasing should actually be extended. It should be a longer period than you would have in the UK. So commercial property investing is never just about the building. Whether you're investing in Birmingham, Barcelona, or Brisbane, the fundamentals remain the same. And understanding the businesses, understanding the leases, understanding the market and the legal structures, and carrying out really rigorous due diligence is so, so important. Get those right, and geography becomes an opportunity rather than a risk. But absolutely do not dive in before you have done any of those things. So if you're heading off on holiday, by all means, go and have a look round, understand market, start to do some due diligence. But I would strongly recommend that you make sure that you really understand, just like you do in the UK, whether that is a niche that you'll be happy to have your long-term investment in, that the structures are right for you and your personal situation lends itself to investing overseas before you commit or buy anything. And then my strongest advice would be that. And, the UK, there's a reason why, as I say, why a lot of investors invest in the UK. Overseas investors, at the top end of the market, they make up a huge proportion of the market. And that's because of our government, our governance, our legislative structures, the transparency of who owns land, etc. It's absolutely in most cases, absolutely 100%. So, that weigh up that kind of safety of kind of that knowledge with other jurisdictions where that might not be quite so clear. Make sure you do checks and balances and your due diligence before you move ahead with that. So hopefully that's been useful. And, if you are in the UK, I would strongly recommend that you cut your teeth on commercial investing, and then you'll have a ton of knowledge that you can apply overseas as well. So I will look forward to seeing you next time on the Commercial Property Podcast.